Stock market is usually quiet ahead of the Fed meeting. Rate hike possibly tomorrow, or are they going to pause? But what we did notice around that 11:30 level is you had a lot of volatility, which was right around the one-year bond auction today. We're going to discuss that and what it means going forward. We need to discuss what's going on with the regional banks and why some look like they're going to absolutely rip, why others look like they're going to come down. Starting to see a lot of fear and panic out there, but semiconductors and technology stocks continue to push. How this one indicator is giving us a signal of what to expect going forward. Push out of this group. That 2040 level on the futures has been a real issue for us. That 4020 level has been a real issue for us. Now we're hanging right in there and we're actually breaking out a little bit. If we went over this yesterday in regards to some of the moving averages and how they're acting in here, very clean, right? You can see how you're respecting the 5. You can see the 200 right in there as well. This is exactly what you want to see. So in other words, we're starting to turn a little bit here, which we discussed the other day. Now you're making that higher high and you have a gap up. You can clearly see the break of the DTL or downward trend line. Let's just take a look at it and so we can see exactly what I'm talking about and just drop that in. So today's day one and you're over. If you get over this tomorrow, you get a higher high, you have confirmed that the DTL is broken and you have the ability to come up here and retest up to that 4160 level, which is what we would be looking to do, depending upon what the Fed does tomorrow. In front of us is the 2-year Treasury, and we can see the peak back here in 2006 during the great financial crisis, and then how the bond market rallied, especially the front end, and you basically went to zero for a period of time right in here before exploding to the upside. At one point this year, you were actually getting 5% to own a 2-year Treasury, which is pretty impressive. You can see that peak level right in here, and you can see how we're holding. Now we've tried to get through this other level down here, this 390, and we have finally broken it. But above really close examination, we've cut it, but we're not really closing under it. So right now we're watching this 385 level, and the question is what happens tomorrow? Well, if the Fed pauses, which is rumored by Goldman that they have now switched to a pausing position, then you could see this rally substantially. As this rallies, equities are supposed to go up. Why that might not happen this time is because people are going to be confused and uncertain about how bad things are. Now, in front of us is FRC, and we're going to look at a smaller time frame. We don't know how bad this is. This is what we do know so far about First Republic. This is the last bank that seems to be having an issue that we're aware of right now. Now, there's rumors that there could possibly be other banks. We don't know. We're certainly not seeing that in the regional index we're about to go over. But we are seeing issues here. We're seeing rallies fail. We're seeing higher highs become increasingly rarer, and there's no follow through with them. You're having gap downs followed by short covering throughout the day and rumors of a deal, but a deal is never getting done. We've been talking about this deal or some kind of deal getting done for a very long period of time right now. We were told about this going into Friday into Credit Suisse. We saw nothing, and we've continued to see nothing. Now, they're going to hold a 2-day meeting in Washington over FRC. The problem with this is if things were going well and you needed capital, someone would come out there and give you the capital. They would come up with terms, you might not like it. That's not what's happening here. What's starting to come out is that they're going to want some kind of government backstop or some kind of government bailout in order for somebody to take them out. Now, if this is accurate, as it's being reported, it's a rumor right now. If this is accurate, it's going to be a real issue, because it's going to be another bank that's going to have another issue of confidence out there, and nobody wants to see that. So with this weighing on us, the regional bank index did not crack. A matter of fact, it held right in here. So we have to start thinking about what gives. Is this a specific problem? How come we're not seeing a panic? We went over the spread in bonds yesterday, and we're going to do it again today just to review how it moved today and what's going on with high yield. But look at that. Look at how you're hanging in there. Now, you would expect to see some massive rollover based upon this if this was systemic. It does not look like it's going to be systemic. So as we drill into these, this PACW, they came out and issued a very nice statement showing their financials. Now, we are not able to get over this level, and we're seeing that really clearly, that 1235. That's okay. We don't need to get over it right away. But once we start getting over that, we've only had one close higher there, and that's right here. And that's not a bad spot to be, guys. That is really not the worst thing in the world, that your 13 would be the highest close since this began. You start getting over these closes as you've been doing, and you have the potential to get up here and get to that 20 range. So some of these names are actually starting to shape up. If you saw the inflows, and this is really how I've been playing it, is buying the PACWP, the preferred, because you're getting, at the time when we started buying it, I was getting over 15, 16% per annum as long as they pay. You start looking and seeing that it's trading the exact same way, but started buying this pre-market like the low 12s. It's done nothing but do exactly what I thought it would do. And eventually you're going to work off this bar over time. That's going to take time. But these kinds of names, you're seeing stability. If we take a look at CMA, which I currently have no position in, but if you take a look at CMA, which is also a regional bank, well, what's going on there? You're seeing pretty clear that you're at a new closing high, meaning that since we've broken down, have this doji and this just utter sheer panic, you're at a new closing high. So we are seeing signs of that. And on top of that, what we're seeing are some of the leading names actually bounce back. So we've seen Goldman now hold in this 305 range over and over again. It's exactly what you want to see. And then you look at JP Morgan, and you have to ask yourself a question. Why isn't JP Morgan rallying? And one of the key issues that we think, it's conjecture, but what we think is going on is that they are the ones that are slated to buy FRC, and they're going to want some kind of discount, and they're going to want some kind of government bailout or backstop. Very clear to what happened at Credit Suisse. And that's why you're not seeing it lift. You're just seeing it just a little doji here sitting right there. So we're seeing that, but then let's just take a look at the entire large cap banking sector and see if we're seeing any cracks there in the bank ETFs. And we're not. A matter of fact, what you're seeing is a new close since this began, this whole little area down here. Not talking about the selling when we didn't know what was going on. We're fully aware of what's going on. But now if you look at the past 2 weeks, look at that area and look at that close. So it's JP Morgan that may have the issue right now, not all the other banks. And I think that's an important distinction. So why JP Morgan didn't continue to push, Goldman did, some of the other names obviously did. It's important to note that some of these banks look exceptionally well and others are seeming to be forming pendants or flags and setting up for larger moves. Yesterday we reviewed the corporate bond yield spread. And the importance of this is just you're looking at the spread difference in yield between BBB and AAA. So you're right along the investment grade scale, but you're looking at the difference in what that yield would be. Well, if we look real close, we can see some really defined spots, can't we? So here's the great financial crisis, and we can see that you had a 4% spread at that time between these two. If you take a look at 2015, when we obviously had some issues, and you can see what happened in 16 right there and how it finally ended. Look at the great pandemic and what happened there. So you can see these areas, even when we had some problems with the bond market, you can see our little level there back in 19. Well, where are we now? We're sitting right here. We are nowhere near any of this. And I think that's an important note. Now, if you drill in on this, looking on a year to date, and you can see right here, well, what are we doing? Well, we're making lower highs. And what is the bond market doing? The bond market's rallying. What are equities doing? What is the S&P doing since this has been happening? Well, the S&P's been going higher. So bond yields are getting tighter, meaning the spread is getting tighter, meaning they're taking risk premium out of the market between these. That's bullish for equities. So then we drill into junk bonds. This is Bloomberg's high yield bond. And now we see real clear their ETF. Now we see really clearly in here, what are they doing? Absolutely nothing. Well, if this is going to be systemic risk that is going to affect the entire market, where is it? We don't see it. If we take a look at iShares, which is the high yield corporate bond fund, what do we see here? And all we're doing is forming a flag and setting up to break out, right? This is exactly what we're looking for and exactly what we want to see. So I don't see any reason to think that this is going to get worse. Let me rephrase that. I don't see any reason why people think that this is going to get worse. They're not acting that way. They're buying high yield. Before we review the next couple indicators, I just want to point this out before we get into it. Apple's breaking out. I mean, that is a clear, crystal clear breakout where you've come down, retested, come down, retested, higher lows over and over again, it's breaking out. Now, the patterns that we go over and the way that I explain things are actual ideas on how I trade. It's not theory, just so we're clear. So when we start pulling back to support levels, and you can see this pretty clearly right in here, how you're sitting right there, and that is a support level, this little area. So when we got down here today, that support held. We placed a trade right here and had a really nice trade out of it. Now, it was very simply a trade, but the point that I'm getting at is if you're holding supports and then you're hitting new highs at the end of the day after coming down, well, somebody has to be buying, and retail cannot stop NVIDIA by themselves. In front of us is the smart money, dumb money confidence spread. And as I like to say, we don't refer to it as that. We refer to this as institutions and we refer to this as retail. Now, what we like to do is we want to understand what this is telling us. The very first thing we're going to do. These spreads, and the wider the spread, the more diversion between institutions and retail. It could be retail that has the divergence where they're buying. It could be institutions where they have the divergence. It all depends. But the bottom line is it doesn't matter. It's about the spread and how far apart they are. So what we are noticing is you'll notice a pattern here. Now, there was actually a study done on this indicator. And I found this really interesting because it makes a ton of sense. So if you look at this confidence spread and you understand that what we're looking at is institutions and retail and then how they differ on opinion. And you remember this spot right here in October. This was a great spot for retail, and retail completely did what? Crushed institutional. We'll go over that in a minute, right? And then you have this down here where everybody agreed, okay? And you can see how it goes when everybody agrees, the market somewhat peaked. But when you start coming up here on these spreads, if you look out historically over a period of time, you're getting a return of over 17%. Now, there's a lot we can do with that, and there's a lot that could be done in between that. But if you're getting a return of 17% over the next 12 months, it can't be ignored. It's something you have to pay attention to. But let's just pretend that we're not going to get that for a second. Let's clean all this off, and let's just look at what I think is extremely obvious, that when you have these peaks, and then those peaks turn down, that you're putting in some kind of bottom. That is becoming really very clear. And then when you're down here and everybody agrees and you have very little spread, what do you get? You're getting peaks, right? But when you have huge divergences and then those divergences start to meet, you're putting in bottoms. So that is how I'm going to utilize this. I'm not going to look at it just for the return that they're saying that they're getting from it, because we don't know if this time's going to be the average, and with an average, you just don't know what you're getting, right? That's why they call it an average. What we do know is that when we rally up on the spread and then come down on the spread and that retail and institutions agree, well, that's when we start moving. And then it troughs out and we hit a peak. Troughs out, hits a peak. Now, if you've been watching these videos for some time, we're basically going over this graph almost every day because it's so significant right now. And again, this is institutions to us and this is retail to us. Red is retail, blue is institutions. And you can see here how retail stepped up and bought and got the run when the institutions didn't. And they sold into the run. Now, you're seeing the exact opposite happen. It's not a question of, I only want to buy when, quote, smart money buys, or I only want to buy when dumb money buys. It's got nothing to do with that. It has to do with the fact of, are you seeing a change in sentiment? And then how is that sentiment affecting the market, right? So if you think like that, it changes the way that you can utilize this. Now, with that said, if you go and take a look at this on a yearly basis, the one thing that we've been pointing out, and I think it's very important, is this cross. And we talked about this cross right in here and how that happened on the 10th. And then since this happened, right in here, 9th, and then the 10th was the next morning. Since that happened, you've been bottomed in the indexes. So once retail crossed over institutions, you have bottomed in the index. And we can go through that later. But what's important about this is, look at the divergence and look at what's going on here. Now let's look at this on 3 months and let's look at what's happening. So now we have institutions up here, and now we have retail that's starting to buy. In other words, retail has gotten to the point from the 17th on where they're looking at this and going, I need to be involved. So they're changing their tune. They're sick of watching the market rally without them. So now retail is going to get involved at the same time institutions up here. So what does that mean? Well, that means that we have a spread right here. And you can all see that spread pretty clearly, right? The difference between these two lines. That spread is this differential that we're witnessing right now. So if we understand what that spread is, and we know that when it starts correcting itself and starts getting to some kind of median, that we get to a point with a bottom in the market, it's very difficult to not want to pay attention to this. Let me straighten this out a little bit so that you can see the top of this as well. There we go. So it's telling us that if we start curling down and retail is buying, then this is probably a possible bottom. Something to think about going into the Fed tomorrow. Now, if you look at the index and you look at our level right here on that Monday after the 10th, when those two lines crossed, gap down, and that was the bottom. We had the panic, and then what did we have? Just outright buying in the index ever since. That's when institutions overtook retail. And all we've seen since this period of time is just incessant buying. And then if you look on social media, which the majority of that is retail, their interactions, they're the ones that are saying we can't possibly go higher, not institutions. Institutions are looking at how the Fed's increasing their balance sheet. I don't care if you call it QE or you don't call it QE. If they increase their balance sheet, it's going to bring a couple things into alignment. We should talk about this. So what is it going to bring into alignment? People are going to buy bonds. Okay, they might not buy them every single day, but they're going to buy bonds historically over time. As they buy bonds and yields come down, the other thing they're going to do is they're going to buy gold. Does not mean that gold is going to go up every day. You have a lot of people that made a lot of money on gold over the past 2 weeks. But what I will say is that as gold goes higher, it's usually due to treasuries dropping in yield. In front of us is the 10-year treasury, and you can see how this was the peak in yields back there in October. If you look at that level in orange right here, you're going to have gold. You can see that gold, since that period in time, has never gone lower. So as the 10-year drops, gold goes higher. It's not a perfect correlation, of course, but I think it's important to note that as yields went higher here, gold dropped off. As rates came back down, what happened? Gold went higher. So you can actually see the 10-year, and as the 10-year drops in yield, people will buy gold. Semiconductors continue to ride this neckline. I really like this trade a lot. It's something that we have some big positions in, or have several different positions in the newsletter in semiconductors. If you don't get the newsletter, link in description. The point that I'm showing you here is, here we are again, trying to rally over and unable to. Now, I don't know if we're going to do 50 basis points tomorrow, 25 basis points tomorrow, a halt or a cut. All I know is Goldman has come out and said from 25 basis points to a cut. We can all sit here and pontificate upon what's going to happen, but quite frankly, only a handful of people know. And if we were betting people, we can pretty much set that the rates are going to be between 25 to flat, right? That they do nothing. I don't think anybody thinks they're going to do 50 basis points or that they're going to cut. I think there are two options, and I think 25 is what we're going to see. The point of that is once it's done, it's over. And once it's over, that uncertainty is gone. And it's possible that we even rally depending upon what they say on that. The biggest wild card we have out there is what's going to happen with FRC and if they're able to get it together, which it just does not seem like they've been able to do so far. The news on Tesla was actually big. Moody's making it investment grade actually for the first time. So they now have two rating agencies that have made this company investment grade. The importance of that for the corporation is it lowers their cost of borrow. Meaning if they are junk bond status, they are at one yield. If they are at investment grade, they are at another yield. And this greatly helps the company reduce costs as they borrow to grow. You saw that today. You got to be really cognizant of this particular kind of bar. There's another kind of bar I would like to point out as well. You have to be really cognizant of these bars. When your open is the low and your high is the close and they're long like this, you need to pay attention. They don't always have follow through, but you can see here, this one had significant follow through. This one did not, took a couple days before it broke out. It's very, very rare that something that is going to be that long in green is not going to have follow through. Even in a down market, long and follow through, even in these bear markets, you're seeing it. You're seeing that higher high eventually. It does take time sometimes, But just the sheer size of that is something that I would be paying attention to. And the just absolute inability for that to even crack today. You can easily get back up to 208 tomorrow. I'm not so sure how interest rates or what they're going to say is going to affect Tesla. I'm not really sure how it's even going to affect semiconductors and NVDA. I'm not sure how any of this is really going to be infected. I don't think it can be infected. I think that you're just going to see a pullback in these names, and that's going to be it. Now, this was a lot prettier going earlier, but essentially you have a dragonfly up here. Now, dragonfly dojis are pretty significant. They usually predict bottoms. But the thing about this is now we're closing on a dragonfly at the high. It's pretty rare to see that kind of pattern up here. It's extremely bullish. Now, we walked through this trade earlier today, but there is very little preventing us from getting to the top of this on the weekly. I don't see any reason that we're not going to do that. All we've done is just consistently every week since January closed higher except for one, and then this was basically flat. So I have a hard time thinking that this is not going to break through. They were at the AI conference today and they did exceptionally well. I don't want to get tied up in 20 basis points, 20 basis points, 40 basis points. It doesn't matter. What matters is the reaction tomorrow. It's very clear that the bond market thinks that we're going lower in yields. It's very, very clear. It's very clear that people are buying technology. You have a really very wonky cup here, right? Some might even refer to it as a inverted head and shoulders. I don't see that because of this move, but I've got a bullish engulfing inside that handle, and I broke out of it today into the Fed meeting. I can only trade what's in front of me. I can only trade what's going on. I don't know what's going to happen, and my wild card is going to be that First Republic. But if you take nothing else from this, take into account that what is working is very simple pattern recognition and understanding where your support and resistance is. If you understand that, then half the battle is there in your trading. I would watch this video if you haven't already. I've gotten really good reviews on it. It should literally take you 10 minutes to get through, and it can actually help greatly with the way that you're trading and setting up your trades. You'll be able to do this by yourself if you watch these videos. After a while, you'll be able just to pick it up. It's not that complicated what I'm doing, and it works great in stage 1 markets, which is exactly what you're in. You're in a base right now. You can see how we got right up to that gap fill, and then we halted right on VWAP. You don't want to be buying up here. You want to learn how to spot where these are and then learn where these turns are. So if that's of interest, you're going to want to watch this video. Please comment. Your comments are greatly appreciated. I read every single one of these, and if you find value in this, please share it. Have a good night, everybody.